Bristol-Myers has crashed to a new 52-week low. It is down around 34% over the last 12 months, and for a company that has a forward yield around 5.5%, there is a lot of upside in this company. In today's episode, we're going to investigate this company in a lot of detail. We're also going to take a look at their pipeline that is upcoming for lots of growth over the next few years. We'll also take a look at their recent acquisition, how that is going to propel their top line. As always, we will look at their dividend safety, which is important for a company that does offer a fairly strong yield, and the underlying support. We'll also look at any insider movement, buys and sells, as well as the institutions to see what they are doing quarter on quarter. And given we now have updated numbers, we'll look at their top line revenue growth as well as their bottom line net income, and also revisit the health of this company, their total cash versus their total debt. And as always, we will run them through the updated valuation, getting to our intrinsic value, getting to our acceptable buy price given our investor margin of safety, and we'll look towards Wall Street to see how much upside they are insinuating for this company with already a very nice starting yield. Now, before we jump into today's episode, just to let you know, we have released our latest free weekly article where we run through 20 undervalued dividend stocks to consider for the portfolio. If you're interested in signing up completely free, do click on that pinned comment below. You get instant access to all of these articles, and for those that do ask what are the websites that we use, you can find out in this article where we do explain all the resources that we look at for each individual stock analysis. Back to Bristol-Myers then, as we can see at its 52-week low, we do note that we have one buy rating from Seeking Alpha, a double hold, and we do have a very nice forward yield. We also do want to point out that the forward P sits at 79. However, this is due to the acquisition costs, and we will revisit this shortly to understand the true nature of what the forward P is. And over the last 10 years, we do note it is down nearly 10%, although if you were to reinvest those dividends, it would be slightly higher. And we do also note all-time highs sit around November 22 at around $81, and it is currently trading nearly half that price. So let's dive into the numbers. Now, we do always typically on the channel want to see 3 to 7% growth year on year. What we noticed, around 16 billion in 2014, 3 times growth in that latest annual report, 45 billion. So nice to note, over the longer term, it has been increasing. The only thing we would say on a graphical basis, while it has moved in the right direction, the last 4 years have looked to be fairly flat, so it will be important when we do analyze their pipeline as well as their acquisition to ensure they can keep increasing their top line year on year. In terms of their bottom line net income, well, again, very similar, we do want to see increasing, and in fact, whilst the top line has increased by 3 times, we do note the bottom line has quadrupled times by 4 from 2 to 8 billion, although we can see a little bit of inconsistency, in fact, a net loss in 2020. Otherwise, over the longer term, it has been moving in that right direction. Always very important to note is the health of the company, especially for dividend paying ones. 7.4 billion sitting in cash and short-term investments in 2014, around 9.7 billion in their latest quarterly report, so a marginal increase from 10 years ago, and we can see over the longer term fairly inconsistent, but it is again increasing over the last 10 years. When we compare the 9.7 billion to total debt numerically and directionally, what we can see here is it has gone from around 7.8 billion in 2014 to around 57.5 billion in the latest quarterly report, which we see as a large increase from the annual report. So in fact, just over the last few months, we do notice a very large increase to their total debt. And what we can see, fairly inconsistent. In fact, the first 5 years of the graph we can see pretty flat. The next 5 we do see very high. So something we do need to consider for the net debt to EBITDA levels, which is correlating to that dividend safety score that we did see earlier. And as always, we will take an in-depth look. Now, in terms of their earnings, we just want to see how they've performed versus analyst estimates. Over the last 4 quarters, well, they've beaten 3 of the 4 last times. In fact, the last 3 more recent times. The last beat, in fact, just from Q1 24 by 2 cents. 75% track record. Pretty decent in my opinion, especially as they are the more 3 recent. When we take a look forward looking, the next 3, what we do anticipate is negative growth year on year to the earnings per share, something that we do need to factor in. Q2, the next quarter, they are anticipating around negative 4% year on year growth. And as we can see here, the reason why, and we will be one of the presentations that we look at, is the acquisition. Their earnings estimate on a forward basis will be 56 cents. We'll take a look on a non-GAAP basis so we get a truer picture. In terms of December 2025, 6.94, which does give a forward P of around 6.34, which is very, very low for the pharma industry as well. Something to consider, and again, something we will cover in shortly. So in terms of the valuation, typically we do look at some of these grades to understand how it's valued against the sector median, as we can see here. Overall, it gives an A grade. Now, this is essentially the average of these models that we can see here, depending on which one you use. For example, on a price to cash flow trailing 12 months, 6.5 with the sector median 18.6. On a price to cash flow forward looking, 4.9, significantly lower than the sector median at 16. As we can see, both metrics showing a discount of around 65 to 70%. Again, does depend on which ones you use. We won't use the one we typically look at, which is the non-GAAP basis, as we did mention and will cover shortly. It is a bit skewed, so unfair to look at. But overall, based on this, it does get an A grade for valuation, so we are off to a fairly reasonable start. We then take a look at the growth grade. Now, they do get a D+. One of the reasons for this, as we can see, year-on-year growth, in fact, negative 0.7%. Sector median positive and fairly decent at 6.6. Forward-looking, again, pretty much flat, as we can see here. Sector median, high single digit, around the 9%. And what we always like to look at is the earnings per share growth over the longer term. Negative 5% for the next 3 to 5 years. Not that great when you do consider essentially the industry as a whole is around 11%. So again, something that we do need to incorporate into our investment thesis, as well as when we do cover our margin of safety at the valuation stage of the episode. So when we then move on to the profitability grade, it gets an A+. Love to see that for profitability. On a gross profit margin basis, 76%. Very, very strong. Sector median at 57%. Bottom line net income, now this isn't something we do want to see, negative 14% with the sector median at negative 4%, so that is something we will need to take a look at further. And when we take a look at essentially the cash from operations, 13.7 billion, significantly better than the sector at 16.73. So a lot of mixed things that we do need to take forwards. Overall, though, in terms of this part of the episode, a 1 buy rating and 2, 1 from Wall Street and 1 from Quant, an A grade for valuation, a D+ for growth, and an A+ for profitability. Now, before we move on to the next part of the episode, let's just have a look at how they do compare against others in the industry. We have GSK in pharmaceuticals, Zoetis, Merck, as well as a few others. Now, over the last year, this includes those dividends reinvested. We can see BMI is the worst performing, down 31%. Over the last 5 years, we do see them positive, but still pretty poor at 11%. You do want to be looking at a lot higher than that over the course of 5 years, especially if you are reinvesting dividends. In terms of over the last 10 years, not that great at all. In fact, 22%. We do see GSK even at 33%. So again, the sector as a whole has been very mixed. There are a few winners that we can see here. Zoetis, which we have covered not too long ago, a very good prospect to consider for the portfolio, as well as Merck that we can see here looking fairly decent. Again, do remember though, past performance of any of these companies or competitors is not an indicator of future performance. Now, before we do touch upon dividend safety, just a few more things to cover. The first one, looking at any insider movement. Now, 0.09% insider ownership, very small. 2 instances, however, of insider buying over the last 12 months for around 673,000. However, 2 instances of insider selling, 1.15 million. And when we do take a look at this on a quarter-on-quarter basis, we do have to go back to Q4. In fact, the more recent part of any insider movement has been a large insider buy in Q4, 673k. Then we do see insider selling Q3 of 2023 at 1.15 million. When we take a look at who exactly this is, well, in fact, we also include in here the US Congress members. We do see Tommy Tuberville. He is quite an active investor. We see him a lot across a lot of these episodes. But as we can see, the CEO, in fact, Christopher S.B., he did buy on the 5th of December 2023, 2,000 shares. Just after that as well, we do also note 3,000 shares around the $48 to $49 mark, and we can see here a fair amount of buys. Very similar to the director, but again, as always, this isn't something we would incorporate. It is a little bit too outdated, but if you want to, the information is there for your own investing analysis. We then move on to institutional ownership, 76.41%. We see 51 billion worth of buys by institutions, which is a lot higher than the number of sales, 8.2 during the same period. And what we can also see in the more recent quarter, 2.5 billion buys versus 1.3 billion sales. And we note the exact same thing for the previous quarter. So although we do in fact note more insider selling than buying, the more recent insider movement has been buying, and the same can be said for the institutional buys, more institutional buys over the longer term, as well as the last 2 quarters. Again, lots of useful information there. So let's just jump in a few things that we do want to pull out from their Q1 results, including their pipeline. First, let's just take a look. Something that we did want to highlight is on their Q1 24 versus the same quarter 23. We do see growth on both their legacy numbers going from 6.9 billion to 7.1, as well as on their growth numbers. In fact, their growth had some very large increases, 8% year on year, 11% if you were to exclude the FX rate. We do see a number of their growth brands in their portfolio. In terms of the legacy, 2% year on year, a little bit higher, plus 3% if you do exclude the FX rates. Overall, it does look positive. The next thing that we just wanted to highlight in terms of moving forwards on their guidance, they are anticipating their top line for 2024 to be low single digits. And again, total revenue excluding FX pretty much around the same. So don't be anticipating large growth to their top line. And again, we need to incorporate that into our valuation. In terms of their essential earnings per share, well, 40 cents to 70 cents is what they're expecting. That is why we got the very high forward P. However, this does include, as we can see here, around 6.73 to the impact of the acquired company, which we will touch upon. But again, this is what we wanted to show. If you do look at it in terms of removing that impact, it is expected to be around 710 to 740. However, we can see here the total deals does impact around $6.73. Therefore, the revised diluted earnings per share does come between those numbers that we had previously said. Now, in terms of looking at the phases, as we can see, before we do run into this, we just want to explain what these different phases are. And this is a good website that I did find just to explain. So there's phase 1 trials. Now, these are primarily concerned with establishing a new drug safety as well as their dose. They'll look to around 20 to 100 healthy volunteers for this to take place. Remember, there are a significant number of years that it will take for them to move through the different stages. Then we move on to stage 2, which essentially determines the effectiveness of these drugs. And again, we can see the number of volunteers does increase. And then we move on to phase 3, which again, you are looking at a larger number of people. We can see here going from several hundred to several thousand. Each different phase does take quite a lot of time. And then you do move finally on to the registration, which is once the phase 3 study is completed, they can then request an FDA to approve the market. And this is called an NDA, new drug application. All of these do take time, but as we can see here, they have a lot in the pipeline. Phase 1, I'm not going to go through these specifically, but you can see on the screen. We then have phase 2 here as well. And if we go down, we can also see the phase 3 as well as the registration, which hopefully shouldn't be too far off before they do get circulated for public use. And they are also having some in the registration that we can see here that are looking likely to be released very soon. The different areas that we have, the oncology, immunology, cardiovascular, hematology, as well as neuroscience, and hopefully these will help people in their life as well as increasing their top line revenue. The other thing that we did just want to briefly mention was their acquisition of this company, which is why, as we can see, their earnings per share is significantly lower. As we can see, they did announce, although this is around February, so a few months ago, that they completed their acquisition of Resi Bio Incorporated. And as we can see, this is essentially a company that does, or in fact is, one of the fastest growing new modalities for treating patients with solid tumors. Obviously, BMY did acquire this company. They do believe it will significantly impact their top line moving forwards. Right now, we won't be able to see the effects of this, but hopefully over the next few years, as well as the annual report and forward guidance for 2025, we can see the implications of this for shareholders. So let's jump into the dividend safety underlying metrics. A score of 70, it does look to be safe. Market cap just under 90 billion. It is a large cap company. We also note just last week their dividend safety score was reaffirmed and a dividend cut does look to be unlikely. Then when we take a look at the last recession, 07-09, they in fact maintained the dividend. They didn't increase it, but again, they didn't cut it. They had negative 21% recession sales. This was below the average, negative 12 for the S&P, but they did significantly outperform the S&P, negative 32 versus negative 55. Dividend growth for a company that pays a yield of around 5.5% is pretty strong, 5.3% last December. Remember, on this channel, we do advocate a minimum of 4% just to keep up in line with inflation. Reason being, over the last 40 years, the US inflation rate was 4%. If you are getting less than that, whether it's your dividends, your salary, your other income producing assets, you are taking a pay cut and losing your purchasing power. Last 5 years then, as we can see here, 7%, so very strong. And over the last 20 years, at a minimum, they are increasing those dividends in line with inflation. Now, they've got 17 years of consecutive increases, but they have been paying a dividend for the last 53 without reducing. Now, dividend yield theory, as always, it does state a company is undervalued when the current yield sits above the 5-year average. A significant undervaluation, severe undervaluation, in fact, the highest yield they have offered over the last 5 years, and we can see on a forward basis 6.5 below the 5-year of 8.9, so a double undervaluation signal, in fact triple, as the PE is lower than the healthcare sector of 16.1. Just bear in mind, we're not looking at any one of these models in isolation, and we will conclude shortly towards the end. Now, free cash flow payout, as always, our focus, below 50%. From 2018, it has been below that consistently, as we can see, the last 6 years. 2024 expected 35%, so very, very strong. I'm fairly confident that over the next few years, they will still increase those dividends at a bare minimum in line with inflation. Free cash flow per share has been increasing over the longer term, which is an incredibly strong sign, something that we do want to see over the longer term. 2024, 685 as well, so it's continuing to increase. It is a little bit inconsistent over the longer period, but the main thing here is that they're continuing to increase it year on year. In terms of sales growth then, very, very inconsistent. 3 to 7% is our target. The last 2 years, very poor, but if we look before that, it has been very healthy, so hopefully with their acquisition moving forwards, they will be able to increase it larger than expected for 2024, which, as we said, is low single digit. Numerically speaking then, just another way of what we looked at earlier. Shares outstanding, unfortunately, whilst we love it when companies do return that excess cash through those share buybacks, they would have diluted your position over the longer term. But we note if you are a shareholder from 2020, they have been doing those share buybacks. So again, does depend on at what point you did buy the shares in the company, if you are a shareholder even. ROIC then, this is one that we look at to give us faith management are able to effectively allocate their capital. 10% plus for me, but as we can see for biotechs, it does get a bit higher from what we saw from 2014 to 2018. Since then, it has come down significantly. Just nice to note, it is at least double digits over the last 3 years, 11% on a trailing 12-month basis. Margins then for biotechs, a little bit higher than the other companies we look at, 25%, and they have struggled over the longer term, something just to keep an eye on, but as we can see, the last 3 years, at least in the high teens, low 20s. And in terms of the free cash flow, very, very strong from 2017 onwards, looking very healthy, 28% in the more recent year. We then move on to the final net debt to EBITDA. Remember the earnings before interest, tax, depreciation, amortization. These are the number of years it would take the company to pay off all of that debt net of cash on hand. Below 1.5 for biotechs. It has been below that for the large part of the last 10 years. What I would say is, as we saw, their debt has increased quite dramatically just over the last few months with this acquisition as well. 5.57, it is pretty high, something that I would say just to keep an eye on, although we do note the free cash flow payout is very low in the low 30s. Then again, this is something that does worry me a little bit, but it is something we will consider quarter on quarter. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically we run through 4 models, which we will take a look at today. However, Graham's valuation and multiples are irrelevant given the fact that the earnings per share on a trailing 12-month basis is negative. So we're going to jump into the DDM model. We have the dividends year on year, average growth rate 8%. Forward looking, we've gone more conservative, lower than the average, lower than the increase from the last year as well. This gives an intrinsic value of $67. We have undervaluation signal. Just bear in mind, we're not looking at any one of these models in isolation. We then have the DCF model, free cash flows year on year. Nice to note that just over the last year, it increased by 6%. Forward looking, 30%, or in fact, average is 30%. Forward looking, we've gone a lot more conservative, negative 4%. Incorporating the discount rate of 8%, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we do see a marginal undervaluation signal here as well. As always, you can grab a copy of the valuation model by clicking on the pinned comment below, getting to both the intrinsic value and acceptable buy price of companies in your own portfolio, as well as those on your watch list. Remember, we only execute on 10% if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Then we keep going till it's near the current trading price to see what MOS level we have in today's episode, and we can see around 8 cents shy. So we would say Bristol-Myers Squibb in today's episode, based on our estimates and judgments, has a 25% margin of safety. terms of Wall Street, well, they see upside of 20%, a price target slightly lower than our intrinsic value, and for a company that has a yield of 5.5%, upside of 20%, and around a 25% margin of safety, this does look like one to consider for the portfolio. However, as always, do let us know your thoughts in the comments below. Is this one you're looking to add? Maybe it's one on your watch list, or in fact, maybe it's one you're not interested or want to sell. As always, if you enjoyed the content, smash the like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.